Let me ask you something. What if the biggest mistake you could make right now isn't buying the wrong coin but not understanding why the game has permanently changed? Because here's what nobody is talking about. The infrastructure that took Bitcoin 15 years to build, the ETFs, the institutional pipelines, the regulatory frameworks, XRP is now running through all of it, simultaneously. And most retail investors are still asleep at the wheel. Today I'm going to walk you through exactly what's quietly happening beneath the surface of the XRP market, the data that doesn't lie, the technology that nobody fully explains, and why the next 18 months could look nothing like anything we've seen in this space before. Stay with me. This one matters. Let's start with something cold and factual. When markets feel boring, when price just drifts sideways and the YouTube comments fill up with people saying XRP is dead, that's almost always when the most important thing is happening. And that thing is called silent accumulation. Think back to what happened with Bitcoin in late 2020. 4 months, BTC barely moved. Social media was quiet. The casual investors had wandered off, but behind the scenes, publicly traded companies, hedge funds, and early ETF architects were loading up. When the price finally broke out, it didn't just go up, it went vertical. Now look at XRP today. ETF products are quietly crossing milestone after milestone in total holdings. The key word there is quietly. These purchases aren't always happening on open exchanges where you'd see the price spike in real time. A significant portion moves OTC, over the counter, meaning institutional buyers are deliberately purchasing in ways that don't disrupt the market. They don't want you to see them buying. They want low prices for as long as possible. But the data still leaks out. Holdings disclosures, quarterly filings, on-chain wallet analytics. And when you line it all up together, the picture it paints is one of relentless, patient accumulation. The kind of accumulation that historically precedes enormous price discovery. Here's the question you should be asking. Why are the smart money players loading up while retail is losing interest? Because smart money isn't trading sentiment. They're trading fundamentals, and the fundamentals for XRP right now are arguably the strongest they've ever been. Let me step back for a second and talk about something most YouTube videos completely skip over: why institutions are even interested in XRP specifically. Not just the ETF numbers. The actual underlying reason. You've probably heard the word DEX thrown around. Decentralized exchange. Most people associate it with Uniswap or maybe newer DeFi platforms built on Ethereum. But here's something that genuinely surprises people when they hear it. The XRP Ledger was running a fully functional decentralized exchange before any of those platforms existed. We're not talking about a test environment. We're talking about a live operational order book system for trading assets peer-to-peer without a central authority controlling what trades go through. Now, why does that matter to institutions? Because institutions don't just care about speed or cost, those XRP Ledger delivers both. What they care about, especially after watching the chaos of centralized exchange failures over the last few years, is manipulation risk. On traditional exchanges and even some blockchain platforms, there's a phenomenon called MEV, maximal extractable value. In simple terms, it means someone with privileged access to the system can see your pending transaction and front-run it. They can jump in front of your trade, take the better price, and leave you with the worse one. It's legal, it's systematic, and it costs traders billions of dollars a year. The XRP Ledger was architected from day one to prevent this. Because of how its consensus mechanism works, where no single validator has dictatorial control over which transactions get included in a block, there's no privileged position from which to front-run. The exchange built into the ledger is structurally fairer than anything that came after it. For a bank, a market maker, or a settlement institution moving hundreds of millions of dollars at a time, that isn't a minor detail. That's the whole ball game, and that's not marketing spin. That's the architecture of the system itself. Now let me address the frustration that I know a lot of you are feeling, because I think it deserves an honest conversation rather than just hype. If XRP's fundamentals are this strong, why hasn't the price exploded? Why are altcoins in general still lagging so far behind Bitcoin? Here's the real answer, and it's not complicated once you see it clearly. Bitcoin has had a head start in terms of institutional product availability. The ETFs for Bitcoin have been live longer. The trading volumes are massive. The Wall Street infrastructure is more mature. So when a pension fund or an endowment allocates to crypto, the path of least resistance is Bitcoin. That's where the products are. That's where the liquidity is. But here's what's changing, and changing fast. The pipeline for regulated crypto products is expanding. XRP ETF products are gaining serious traction in terms of assets under management. More importantly, events like major industry conferences are no longer developer meetups. They're becoming financial infrastructure summits, with the largest banks and asset managers in the world showing up as headline sponsors. That's not a cosmetic change. That's a structural shift in who controls the narrative and where capital flows next. The altcoin lag isn't a sign that altcoins are broken. It's a sign that the institutional on-ramp is still being built, and historically in every previous cycle when that on-ramp opens up for a new asset class, the move is fast and it's violent. The people who miss it are always the ones who gave up right before it happened. Here's where I want to get practical with you because I think there's a dangerous pattern in how crypto content gets consumed. People see a liquidation cluster on a heat map or they see a leverage ratio spiking on a derivatives exchange and they panic. They think the market is about to crash them out. And sometimes honestly, sometimes it does. That's the risk. That's always the risk. But zoom out. Leverage gets crowded in both directions. When too many traders pile into long positions, a flush to the downside can happen. But when conditions are right, when the underlying demand is real and growing, those flushes become buying opportunities, not trend reversals. The distinction matters enormously. A leverage flush in a market where institutional accumulation is ongoing looks very different from a leverage flush in a market where fundamentals are deteriorating. Right now, with ETF holdings growing, with major financial institutions expanding their exposure to digital assets, and with regulatory clarity slowly emerging, the macro backdrop for XRP is the strongest it's been. That doesn't make short-term volatility disappear, but it does change what that volatility means. Think of it like a coiled spring. The longer the sideways period, the more energy is being stored. Springs don't leak that energy slowly, they release it all at once. Let me paint you a picture of what the catalyst actually looks like. Right now, the biggest thing holding back utility token adoption at scale isn't technology. The XRP Ledger works, it's been working for over a decade. The bottleneck is legal clarity. Financial institutions need to know with certainty what the rules are before they plug XRP into mission-critical payment systems. That clarity is coming, not as a rumor, not as hopium, but as a legislative and regulatory reality that's been grinding forward for years. And the moment it arrives, the moment a bank can confidently run a live, full-scale payment corridor using XRP and not worry about regulatory blowback, is the moment the OTC accumulation shifts to open market buying. And that's where price discovery gets interesting. Consider what's already been set up: partnerships between Ripple and major financial institutions, integration into settlement infrastructure used by some of the biggest names in global finance, a stablecoin running on the XRP Ledger with growing 24-hour volume. These aren't prototypes, they're live systems being stress-tested and quietly scaled. The tokenization of real-world asset stocks, bonds, real estate, commodities is moving from conference buzzword to actual implementation. The institutions building those systems need a ledger that's fast, cheap, manipulation-resistant, and regulatory-friendly. Every one of those checkboxes points directly at XRP, so let me bring this home. The reason most people miss transformative moments in financial markets isn't because they didn't have access to information. It's because they got bored, or scared, or distracted. They walked away at exactly the moment that patience was about to pay off. The data right now, if you read it honestly, without the noise, is telling a very specific story. Institutional money is moving in. Infrastructure is being built. Regulatory clarity is approaching, and an asset with a 10-year track record of real-world functionality is sitting at the intersection of all of it. That doesn't guarantee a price target or a date. Nothing in markets does, but it does tell you which side of the trade history is most likely to look kindly on. Be where the future is being built before everyone else shows up. If this broke something open for you, drop a comment below and tell me what surprised you most. And if you want me to keep digging into these data points week by week, you know what to do. I'll see you in the next one.